Welcome to our latest webinar for corporates. In this series, we'll be examining recent events and looking ahead at what might be in store for financial markets and the economy. Good morning, everybody, and welcome to the March edition. My goodness, it's already March already. March edition of the FX webinar. Hopefully you have found the first two interesting of 2024, and this is likely to be no different in terms of that we've got a lot to discuss as far as macroeconomic and market trends. So I'm not going to waste any time. I'm going to go straight into the content slide of my presentation, which is this one that's being brought up now. You can see here that I'm going to do things slightly differently to how I would do things normally, because I'm going to talk about the fact that the markets have been remarkably stable over that first couple of months. And then we're going to be looking again at interest rates. We started to have a lot more debate about the timing and scale of rate cuts. So we'll talk in greater depth about that. I want to talk for a little bit about real estate, splitting out the difference between real estate from a commercial perspective and real estate from a residential perspective. Then I'm going to get into the thing that's happening today at 12:30, the UK spring statement. Many of you might think, well, what's the point? Everything's been leaked in the press, but we're still going to be discussing that for a while before we look at the latest set of FX market forecasts. And of course, finally looking at the disclaimer, again, repeating that neither myself nor Piers offers advice. These are just forecasts and views. So on to the first slide about this period of FX stability. And what I've done here is index both sterling dollar and euro dollar from the beginning of this year. And you can see that actually the movements have not been that material. And to put it into context, in 2023, the first 2 months saw a over 6% swing in sterling dollar, like if it had been indexed, and whereas now the move has been somewhere in the ballpark of around 2% between its high and its low, maybe even less than 2%. In fact, euro dollar has moved more and has actually been underperforming up until very recently. So euro dollar will be interesting to see whether or not it continues to underperform, because that will clearly have a key impact on the performance of things like sterling euro. Now, I find it amazing that this period of FX stability has taken place, given a lot of the risk factors that are still in play. So we've still got the problems around economies. Both the Euroland economy and the UK economy are in recession. You know, Euroland at best as well is going to go through a further challenging period over the first couple of quarters of 2024. More importantly as well, I think it's becoming increasingly obvious, and in fact I saw a piece written on this today, that monetary policy is increasingly restrictive, and that is having a negative effect on households and businesses in terms of the squeeze on credit that it appears to be having. So financial conditions are definitely tightening. We've still got those geopolitical factors in play. So Russia, Ukraine, is there going to be a greater development in that particular conflict? Will we continue to see the US and UK and other allies striking targets in Houthi-held Yemeni territory? And also, what about China? The weakness of Chinese economic activity is still something to be concerned about. We've got US and UK politics in the spotlight. Mentioning UK politics a little bit later on, but in the US we've just had Super Tuesday, where Trump won 14 out of the 15 states in those Super Tuesday primaries, and chances are that he will be the presumptive Republican nominee before too long, if not the actual Republican nominee before too long, given that we've got a few further primaries due over the course of the next week. Also in the spotlight, though, is the rising tensions in Europe, and particularly Euroland. Farmers' protests continuing to go on because of a perceived set of policies that are detrimental to European farming and actually support cheaper imports. We've got equities that are continuing to show signs of froth. is this another tech bubble, or is it a more broad-based gain in equity markets? Is that due to markets pricing in lower interest rates? And we've got, as I mentioned, signs of credit tightening. We've seen further problems in the US regional banking sector of late. And then finally, I wanted to draw your attention to this other point. Customers are telling us that they are being more reticent in terms of orders. So they are ordering less. They're also seeing orders placed on them reducing as well. And they're saying that they're being pressurized to increase payment terms from bigger multinational type companies. So all of those factors, I think, would warn against being too complacent about the stability that we've seen in foreign exchange markets. Moving on to the next slide and looking at the interest rate environment, it would still appear that the US Fed are the key driver in all of this. So they will likely lead things off. But if you look at this from a macroeconomic perspective, I would suggest that it's Euroland that maybe have to dig in and start cutting interest rates earlier than all of the other central banks, given the underlying weakness that we're seeing from a macroeconomic perspective. And the UK might end up being the second of the three. So the US might be last to start reducing interest rates, but then be more aggressive in terms of the scale of interest rates that they're prepared to sanction. But we have revised materially our forecast as far as Fed fund interest rate cuts are concerned. So we did have 2.25 percentage points in the year ahead forecast. That's now been revised down to 1.25 percentage points. Now that might have some strengthening effect in terms of where we see the US dollar heading. If they do much less, and proportionally the UK and the European Central Bank do more, then I think that could be beneficial to the US dollar. Now, if we move on to the next slide and look at what's happening in global real estate, well, the problems in China have been well documented and are predominantly driven by issues in both sectors, rather than it being one or other. So rather than it being the residential or the commercial real estate sectors, China's problems appear to be dual as far as real estate is concerned. Whereas if we were to look at the US, then their problem appears to be much more centered around commercial real estate issues. And certainly those problems with some of those regional banks in the US appear to be commercial real estate in nature. Equally, if we look at Germany in Euroland, then the problems there appear to be more commercial rather than residential in nature, particularly around office space, alongside the long-standing problems that we're seeing within manufacturing. And then if we look at the UK, we are seeing, again, problems and pressure that has come from the commercial sector, although those are much more mature in nature. And I think that there is another problem building. We've started to see house prices ticking back higher again, and that's down to a lack of residential supply. And there appears to be some hiatus from house builders as far as additional residential supply, which may cause house prices to rebound far faster than we were previously expecting. So the global real estate picture is very much a mixed bag, but there are significant problems globally as far as the commercial real estate businesses are concerned. And I think that will cause some degree of alarm as far as the central banks are concerned, because of the problems that it might then create in terms of credit. If you start seeing losses building in the commercial real estate sector, which means non-performing loans start to rise within that, then could that have a knock-on effect? But again, particularly in China, I think this is where I'd be concerned. There's a lot of exposure either within the major banking sector or within the shadow banking sector and the smaller banks. So China is one to watch here in terms of those global concerns, and that could have a knock-on effect onto currency valuations. Now, if we move on to the next slide and we look at the UK spring statement, according to a report in the Sunday Times, the Office for Budget Responsibility have said that the Chancellor only really has around £12.5 billion worth of headroom for tax cuts and spending increases. And then we've had a further report over the last 24, 48 hours that the Chancellor intends to cut national insurance from 12% to 10%. They think this is the best way to go. It's cheaper than cutting income tax by 2p. So I think it costs around about 9 to 10 billion pounds to do the NI adjustment, whereas it would cost around 13 to 14 billion pounds to do the income tax adjustment. And I think the other thing that they wanted to try and get across is it rewards purely workers, whereas income tax cuts potentially have a benefit to people that aren't working, like high net worth and high net income pensioners, for example. So I think that's one of the reasons why they've elected to do that. But there have been other indications within the press about the possibility of stamp duty changes, the possibility of abolishing it for a broader number of housing brackets, the potential for cuts in national insurance for SME employers to try and stimulate faster rates of investment and growth there. The one that has done the round for several budget cycles now is the abolition of inheritance tax, and that never appears to come to fruition. And there was also something floated about cutting VAT for home renovation, although I'm not sure why that would necessarily be required, given that home renovation was one of the big growth areas during the COVID lockdowns and subsequently coming out of the back end of that. The one thing I would say is I don't think this changes the dial for the UK economy. Those sort of scale of tax cuts is not going to lift growth materially. And more importantly, I don't think that it's sort of a medium to longer term plan for the UK. It certainly looks to be more short termist and more driven towards what they believe might make them more popular with the voting public. So I don't think it's necessarily going to have the desired effect in terms of lifting economic activity, productivity, or any of the other levers that they want to try and influence. So if we finally look at the final slide and the FX forecast, they haven't really changed. I think the only thing I would say is we've been getting stronger hints from Japan around the fact that they may be ending the zero interest rate policy or the negative interest rate policy that they've had realistically for the last 25 years. That could have a positive effect on Japanese investor flows. So we might see dollar yen falling. That could in turn then drag down dollar China, because the Chinese renminbi tries to keep pace with where other Asian currencies are. I still think the macroeconomic problems that China are facing will require additional monetary loosening and will require additional fiscal loosening as well, and those things don't play towards a much stronger Chinese currency. Finally, we have seen weakness recently in things like the Canadian dollar. That's because macroeconomically they're underperforming their near neighbors in the US. We continue to see pressure on emerging markets. I think that has been driven by the fact that interest rate expectations have materially reduced in terms of the scale of the cuts that we were likely to see from the Federal Reserve. So there's a lot to unpack there from a macroeconomic perspective, but my time is up. It just leaves me to leave you with my disclaimer slide. I'll leave that up for a few seconds so that Piers has time to prepare himself. But we look forward to any questions that you may have in terms of macroeconomic or markets at the very end. So Piers, I'd like to hand over to you.
So, thanks, Neil. Very interesting as ever. Fascinating stuff. Right, well, we're going to look at the markets from a chart point of view. And one of the things that Neil has already hinted at is the sideways price action we've been in for some time. It's not just since the start of the year. So if we go to the first slide, this is the dollar index. So always good to start with the dollar index to see what the dollar's doing as a whole. And here you can see quite clearly from the beginning of 2022 all the way along to now, it's mainly been between the 38.2% and 50% retracements. Hasn't really been outside those for very long. But it's quite interesting when you look at it really, because it's waiting for some sort of event to trigger it out of this sideways range. We have broken a very small trend line going up from 2021. We drew it through 2023. Now, you broke that last year. Now, you're sort of moving back up towards it. But the real key area here is going to be that 38.2% at 105. And you've also got just underneath that, you've got the 20-period moving average of 104.75. So that's the area. If you want to see a stronger dollar, you need to see it over 104.75, 105. It needs to break through there on a monthly close, then that will start to help it strengthen. While it's below there, there is a risk it falls back down and stays in this range because we're sort of coming towards the top of the range it's been in. But where is support? So support at the moment is down in the 102.20.30 area, and that's just above the sort of 50% line. So that's where it should find support if this is going to rally and go up and break higher. Where does it actually say, look, this attempt pull back higher has failed? It's if I see it below 101 on a monthly close, then I think this has run its course and the market's respecting that it's below the 38.2 at 105 and the 20-period moving average 104.75. So below 101 is where I've looked for dollar weakness to start to speed up, be stronger and more sustained move. Above 105 is where you start to see the dollar strength improve and the dollar will strengthen up. So that's the dollar index in a very nutshell, but you can see it's just been sideways. So we probably need some sort of shock to the market where the data comes out not as forecast and the markets aren't positioned for it rightly. So we go to the next chart now. We'll look at euro dollar. And again, we'll just look at the same sort of studies on here. We can see that, you know, the area that's providing support here is the 106.12 area from the 38.2%. And slightly above that, you've got the 20-period moving average coming in at about 106.60. So I've had that on my weekly charts for some time. So watch the 106.12, 106.65 area. That's your support. If it breaks below that, that's where euro dollar starts to collapse down lower. But at the moment, that's the support and that's holding. So where's the resistance? We know where the support is now. Where is support? So support at the moment is 106, but resistance, I'd put it first of all, probably around about 109.50, 110. So 109.44 is the 50%, and 110, there's also some highs there that come in there. So I'd say 109.50, 110 is where on a monthly basis, you want to get above to start to change this. Because as Neil highlighted earlier, these currencies have just been going sideways. You know, if we go back to the first month of 2023, euro dollar closed that month around 108.65. And now this month, we're in March, this morning, I saw we were at 108.65. So 13 months later, we're at the same area without having gone significantly higher or lower. So you really need a break out of these ranges. You need something to come to excite the market, to make them think, oh, look, the world's not how we expected, or so that'd be a panic move, or actually I'm more confident in the world and that would be a continuation move. But that's what we were waiting for a break. In the meantime, watch those levels because they'll be good in giving you an early warning signal of a break. So if we go to the next chart, it's the sterling index chart. So on this one, the first slide here just shows where the retracements have come from. Now, if you've been on these webinars before or any of the breakfast seminars we've done around the country, you'll know this is the same chart I've used since 2016. Same retracements we're watching, same sort of thing to look at. But it's difficult to see on this. So if we zoom into the last bit on the next slide, here's the last bit of the price action. And I've circled my favorite one, 38.2%. Price broke above it last year. It simply went up to the 50% where it fell off. It fell off the 50%, came back to 38.2%. Now that, through the rule of polarity, swapped. Old resistance becomes support. So when it got back down to that 38.2% area, it rallied. And where's it gone after that rally? it's gone to the 50%. So really, for the last sort of 6, 7, 8 months, you've had it very simple. Well, actually longer than that, 9 months now looking across there. It's just traded between 38.2% and 50%. So it makes it very simple when you're looking at sterling, deciding, is sterling strong, is sterling weak? We know where things change. Things change is if you break below that 38.2%, and just below that 38.2% is the 20-period moving average. So we can put support at 64, 65, 90. And we can say, while that area holds, sterling's got the possibility of strengthening. If we get below that level, that's when something's changed, the market's changed its view, and sterling will weaken and go back lower. On the upside, where's resistance? Well, we can see where resistance is quite clearly. You know, it's stopped there so many times. It's the 50% at 67. So that's what's capping sterling from making further gains at this stage. But if we can get a monthly close above there, a clear monthly close and hold above 67, then that could open up the move towards 69 and see a further strengthening of sterling. But for the moment, just watch the 38.2 and 50%. They've worked well for such a long time, but go with the break. A break must be coming in these markets because, as Neil said earlier, there's so much going on in the world that something's going to happen that's suddenly going to make these markets just fly. So, you know, in this sideways price action, it's the time where you can plan what do you need to do if it breaks those ranges and be ready for it. Right, the next slide is euro sterling. And I do this next because it's mainly what constitutes the sterling index. But here on euro sterling, I know that's not very popular with everyone here. So we'll go to the next slide, which is sterling euro, just the other way around. Same sort of thing. Initial resistance in sterling euro, I think, is around the 117.30.70 area. And a monthly close above that would open the pressure on 118.50, 119 area. And that should be much stronger resistance than the 117.30.70 area. So watch as the month goes on, how's price reacting to 117.30.70. If it's above that, it might be opening the way up towards 118.50, 190, where, as I say, I see stronger resistance. Where would the positive feel that has sort of come on this move higher go? I think if sterling euro was back below 113, that would be game over. You know, if price closed for a month below 113, 113 and a quarter, it really break the backbone of this rally. Where's shorter term support? Shorter term support should be around 115.40. So really you could look for 115.40 as an earlier warning signal. If it comes down towards 15.40, you should expect to see some support and some bounce. Now, this is the monthly chart, and we're only covering shorter term. But the quarterly chart has a very interesting development on it for the longer term for sterling euro and euro sterling. And it might be quite a significant one, but I will cover that next month because we'll do the quarterly charts next month. But out of all the charts we look at, I think it has the potential for something quite interesting. But we'll cover that next month on the quarterly charts. And that leaves us with the final currency pair we're going to look at today, sterling dollar. So this is the monthly chart. And so this is the chart we look at most of the time. So I always start with the same chart, so it keeps things nice and simple. We can see, what can we see on here? We can see that the 61.8% retracement has held sterling dollar for the last 4 months. This is the 5th month it's up testing that 61.8%. But one thing that would be pleasing sterling dollar bulls is the fact there's been no real strong sell-off, that 61.8%. Before, when we got to the 61.8%, if we look in 2023, price fell back off it quite quickly, down to the 50%, that 20-period moving average, where it rallied back up. But there's been no sell-off. So that sort of suggests people aren't in a hurry to sell sterling dollar, but they aren't that convinced to buy it any further yet. And what do we need to see that sort of move further through? You need to see a close above, I'd say, 127.55.75, that sort of resistance zone, which comes from the 61.8%. And just be clear of it a bit. So we'll say 127.55.75. Then, if you get a weekly close as well above 128.75, that would be positive. But you then come into the cloud. You come into the Ichimoku cloud. So we have to be wary as price always enters the cloud. But that's where I sort of see resistance at the moment, 127.55.75. We can get above there, maybe up to 128.75. But I think that might be a weekly sort of buffer. Where should support be? Well, support should be around 125, 125 and a quarter initially, followed by 124. Now, if we got below 124 and held that for the monthly close, that would put pressure on sterling dollar, and I think lead to a move down towards 123. So I've got one more slide, and we're going to the second sterling dollar slide. I've added a couple of lines here, but I always like to start with the basic charts that we did the last time we did monthly charts. So here I've added a down trend line in black, and that also comes in just above the 61.8%. So that's another reason price is stalling here. It's hitting the trend line, but there's been no strong sell-off that trend line again. In fact, look, we're up testing it this month. So it reiterates the importance of getting through that area. Now, what we can see is that I've also put on an orange line and just done the rally up since 2022. Now, that rally up since 2022, we pulled back and the market bounced perfectly over 3 months off 120.75. 3 times it tested it, didn't make it, rallied back up. So it shows the impulsive trend is still intact. And that's where things go really wrong for cable if you get below 120.75 anytime, because that's the 38.2%. So at the moment, all looking sort of like it wants to try and test through that trend line and the 61.8%, but keep an eye on the areas I said earlier, that 125.05, 124. If you start to get back down below there, then something's going maybe a bit wrong. And there's a lot of things that could happen to suddenly break this. So, you know, there's a lot of data coming out, a lot of interest rate calls. If the economists haven't got the market positioned right for those, you could see some probably big jumps around. But that leads us on to the last slide, the next slide, and that is the disclaimer.
Thanks very much for listening to the webinar. We hope you found it informative. The next in the series will be available shortly.